Speaking of cash, U.S. businesses are cash rich, and Goldman Sachs chief strategist David Kostin says corporate managers should use that cash for M&A, especially by using equity. Don't be surprised, though, if management sticks with their current MO of buybacks. S&P companies spent $2 trillion on buybacks over the past 5 years, and the issue here, Mark, is that management tends to have, let's just say, not great timing. The S&P 500, the Dow, and the Nasdaq are all fairly close to their record highs. The S&P 500 is trading at 18 times forward earnings. So, in other words, stocks are not cheap. Now, in the last cycle, the last bull market, buybacks peaked in 2007. You know what happened after that.
Companies are still insisting on using that cash, even though we're seeing the buybacks and the valuations at these levels. Why?
Well, because they get the near-term pop in their share price. And let's face it, activist investors have been agitating for it, and so they reward companies that do it. So it's this virtuous cycle or invirtuous cycle, depending on your point of view. Goldman Sachs has a really great chart today that shows the amount of buybacks since 2005. So here's the bar chart. It forecasts $604 billion of buybacks this year, the most since 2007, which was the peak of the last bull market. That is up 18% from 2014. The amount spent on buybacks could increase, too, when you consider how much overall cash S&P 500 companies have, because if you look at it as a total percent of cash use, let's show you what it comes out to. For this year, Goldman Sachs estimates that companies will spend 28% of their total cash on buybacks. That's up from 25% last year.
And we saw that story that was being told in 2008 and 2009 when it started to go down, where people were scrambling because we were just in the beginning stages of the financial crisis.
Yeah, in 2007, companies spent 34% of their total cash on buybacks. We're only at 28%. So those bars could get a lot higher before this goes downhill.